a very warm welcome to all of you. I hope you and your loved ones are safe and maintaining good health. Today, I'm going to share with you some key insights from a CRISIL rating study on the growth prospects for housing finance companies or HFCs in the days ahead. Assets under management or AUM of HFCs is expected to increase 10 to 12% this fiscal versus 8% last fiscal, driven by home loans, which could grow at nearly 15%. Growth in developer financing and loans against property or LAP will continue to be muted. At the same time, affordable housing financiers are likely to grow relatively faster at 18 to 20%. Last fiscal, the HFC growth was a story of two halves, stunted to just about 2% in the first half because of the second wave of the pandemic and a V-shaped 14% growth in the second half. The home loan segment, constituting 72% of HFC AUM, grew 11% last fiscal. It benefited from better affordability, improved income visibility after resumption of economic activity post-pandemic, higher demand in urban areas, and increased preference for home ownership. Structural factors driving end-user housing demand remain intact this fiscal despite the impact of rising real estate prices and interest rates. This should drive 13 to 15% growth in the home loan segment. And despite the recent hikes, interest rates remain below previous cycles and haven't impacted customer interest materially. Despite the growth, HFCs are expected to continue losing home loan market share to banks amid stiff competition as banks benefit from access to low-cost funding. HFCs have already conceded 400 basis points market share to banks over the past 4 fiscals, resulting in banks' share rising to 62% as of March 22. The ability of HFCs to compete with banks in the traditional salaried home loan segment remains a challenge given their relatively higher funding costs. And in the non-home loan segments comprising developer financing and LAP, which have been yield kickers in the past, HFC's exposure has reduced in the last few years, and that in turn has put pressure on overall spreads. Going forward, HFCs are expected to increasingly partner with banks and leverage each other's strengths to grow their books. Some HFCs are already moving in this direction. Therefore, on-book growth is likely to be lower compared with AUM growth. One segment where HFCs have been growing relatively faster is affordable housing loans, where competition from banks is limited as of now. Affordable housing financiers, therefore, have relatively better growth of 12 to 15% in the recent past, despite moderation from earlier levels. Given their relatively smaller footprint and large underlying demand, affordable housing financiers are expected to keep growing faster than traditional HFCs. And on that note, I thank you for your time and attention, and till we meet again with another topical theme, goodbye.